Now today we have with us David Grossman. When people come to see us, we don't just talk about bankruptcies and proposals. We talk about consolidation loans. We talk about using resources that they have or might have available, might be accessible to them to try to avoid having to do the bankruptcy or proposal.
Yes, I think that people should start looking to have conversations with professionals like yourself and me before they start missing payments. Mm-hmm. Because as soon as they start missing payments, you know, like we get people who come to us, they have all kinds of equity in their house. And we may have been able to get them, but if they miss payments and they let their credit go downhill, then when they come to us, we can still get them the loan, but it's going to, if the equity's there, but it's going to cost more money. It's just going to be more expensive if they've let their, so they should talk to people, professionals, before they start missing a lot of payments for some guidance.
Well, it's a message in our advertising. We try to get that across all the time.
Right.
And why wait till things have already gone downhill before getting advice? Right. And advice is easy to give, not so easy to take, I understand. But,
apparently.
We have a number of people, this happens fairly frequently, they're insolvent, and that means that they can no longer keep all their creditors happy through their own resources. You know? Mm-hmm. And so they do something with us, but most people don't want to do a bankruptcy. In fact, I think in the 30-some-odd years that I've been in this business, I've never met anybody who wanted to do a bankruptcy.
Right.
You know, I've met an awful lot of people that did because they had to, but they sure didn't want to. Mm-hmm. However, what we do, we provide an alternative to that. It's called a proposal or a consumer proposal, depending. Right. And they do a proposal, and but they've got some equity in the home and so forth. Mm-hmm. So they're paying this proposal, and usually proposals are done over a 5-year period, a 60-month period. And they get maybe 2 years into it or 3 years into it or something. Okay? And like anything else, it's a negative drag on them. You know,
right.
Okay. It may have a positive end, but it's a payment that they have to make, right, and so forth. So we suggest to them, we very often suggest to them that they look at using the equity in their home to maybe pay off the proposal.
Right.
So even though they've done something under the Bankruptcy and Insolvency Act, okay, can you still help them with that?
Well, for sure, yeah. We do get people who are in a proposal alone, but the lenders will typically want to see the balance of the proposal being paid out in one shot from the loan proceeds. I think
that's a normal consolidation loan factor, isn't it? They don't want payouts.
No,
they
because
want 100% payouts.
They want 100% payout because I think, correct me if I'm wrong, but let's say there's a $1,000 a month monthly payment on a proposal. If somebody was to make a lump sum payment, it's not going to reduce the $1,000 a month. No, it's not. So
well,
the only way
I shouldn't say that. It prepays the proposal.
Right.
So they can reduce their payments if they're ahead, right?
Okay, all right, that's an interesting point. Well, generally speaking, though, the lenders, they want to see the proposal paid out in full from the proceeds. Yeah. Now, but I think it's worth mentioning, though, that sometimes when people are looking to do a proposal, they can get a mortgage at the same time and do a lump sum payment.
In other words, they can use the equity to use the proposal process, to fund the proposal process, to get out of debt.
Right, and then rather than having payments over 5 years, they could do it in a one-time shot, and it's done.
And then amortize their payments over a longer stretch, and through the mortgage process and all that.
The Glass is Half Full Talk Show.